Hello, fellow traders. My name is Curtis White from Beyond Backtesting. Today, I'm going to be sharing one key concept all day traders should know. So, this is really came from thinking about my scalping and futures trading and the Apex Trader funding, and it's a very basic concept, pretty trivial, and you probably know this. And so, but I think there's a value in making it more conscious. And the concept is really simple. And again, I wanted to share, I'm sharing this as a scalper, as a day trader, futures markets, but the same concepts apply for any market, really. And the concept is simply this, okay? The market is the market is likely to move significantly more against us than the amount the market can be expected to move in our favor, okay? And what I mean by this is if we're trading, and I don't trade, minute bars or in that way, in that fashion, but the concept holds. So if we're trading 5 minutes, if our average holding time is 5 minutes over the whole day, what do we think the average range for the 5 minute bar is compared to the day? It's going to be very much. It's going to be many magnitudes less, right? Compared to the day's range. And so, if we're anticipating what the reasonable profit objective, if we're going to hold for 5 minutes, and that can be a very long time for a scalper. A scalper might be in the market for seconds, right? Then what we can anticipate reasonably, what we reasonably expect or predict, is much less than the market could move potentially against us if we allowed it to move against us the whole entire day, or it can move, over a short period of time, even if it moves much more. So what I'm saying by this is that, whether it's 5 minutes, 10 minutes, 20 minutes, 60 minutes, even the amount of a range on those time frames that we would expect to see is less than the range of the day. Okay, and it can be many magnitudes less. So let me give you an example. If we're scalping for 1 point, the range today was very muted. It's like a 15 point range during the time I was trading it. But looking over the recent days, we've had 60, 70 point ranges. Obviously, the ES is increased. So when there was a time when the 40 point range was 10, 20 years ago, because of the pricing was really unexpected, and now because of the price differential was trading at, I think, 4,000, 4150, 41 something. You take that 1%, that number is much bigger, and so we have some really big ranges. And so if we take 4150 times, let's say 0.1%, it's a 40 point range, okay? And we know that you can have 2% days, right? That's 83 points, right? And you can have even larger days. So what we're talking about is you're talking about potentially 80 times larger the market can move against you, right? Compared to what if you're scalping for 1 point, can be expected to move against you. And of course, that could be bigger, much larger on a day where we get, a really good trend day, that, a rare type of day where we get a 3% or a 4% or a 5% type of down day, or up day. And it could be short too. So, and this same concept obviously is going to apply if your trades are bigger. Then you might say, well, I don't trade for a point, but no matter what you're targeting, if you're targeting 10 points, right, then we're looking at, you potentially could be 8 times, right? You could lose 8 times. You could be expected to lose up to, 8 times what you could be expected to make. And that's a 10 points. So it can be a very large, that's a pretty large target, right, for an active trader. So whatever we're targeting, the market can move many times. Whatever we can be reasonably targeting, like if the market moves over 5 minutes, what we could expect over the next 5 minutes, the market can move much more against us than what we expect, and what that means is that we can lose significant amounts of money, or lose our accounts if we don't manage the risk properly with stop losses, with time and market management, with position size management, risk management of different forms, various forms. But this is such a powerful concept because it shows the importance of risk management, and it explains, how something that, as a scalper, you may win 4, 5 trades in a row, and can be a tendency to start to get confident or overconfident. Okay, you put up 4 or 5 wins in a row, and there's, some traders feel like, okay, now they put some profits up, now they can take some more risk, but we can see that may not be the case. And we, in terms of how much it can move against you, you've put up, if you have 4 or 5 wins in a row and you're a scalper, one mistake easily could wipe out that and more, right? And so I think that kind of explains why that happens, how that can happen. And I think it shows the importance of a risk management plan with one's trading, and the importance of being cognizant of not getting overconfident, particularly if we're scalping or active trading, because we can see that simply putting up several winning trades in a row or in a day or what we want to say, you haven't really built up a cushion. It's just this idea, okay, you built up a cushion, but when you see this math, you can see that's not really the case, right? And it speaks to the type of performance that, if you're attempting to be an active trader, active scalper, that you need to, adhere, aspire to, or, strive to, what you want to say, in order to be consistently profitable. You need to be, winning, either having very good risk reward ratios, or winning have a very good win ratio, and or both. But it also shows the importance of risk management from a trade perspective and from the daily loss perspective. And everyone says yes, the importance of using stops, they understand that, but I think this may be more helpful than just saying traders use stop loss or whatever. And so I don't have all the answers, so to speak, on this, but just something that helps me, that I think about as I try to frame my trading methodologies, and I try to consider what is reasonable or not reasonable, or what is sensible or not sensible. So I hope it helps. I hope I didn't drag it on too long. Thanks for listening.